to this episode of Mo Money. I'm Alexander Paul Morris, your host. M3 money supply figures are back! Well, unofficially. You may recall some of my earlier vlogs regarding the small point that the Fed decided to stop publishing the M3 money supply figures since it didn't feel it was important for us to consider and wanted to de-emphasize the role of M3. Pretty fishy sounding, wouldn't you say? Of course, M3 was the broadest of the money supply figures and the fastest rising indication of the year-over-year money supply growth rate, or in other words, how fast the Fed was pumping fresh new money into the system. I had mentioned that I could only imagine what would happen after the figures were no longer published. As it turns out, while the Fed may have been able to partially de-emphasize its role, it has still been possible to extrapolate it quite accurately into the future using other data available, and the figures are quite staggering. Any wonder why the stock market has been rising so strongly as of late, exceeding so many investors' expectations? All that newly printed money's gotta end up somewhere, and I don't think it's going into real estate anymore. Just wait for my episode on that topic. Now, just to clarify, this doesn't mean that stocks can go straight to the moon either. That depends on how many investors are bullish on heavy leverage. It's the leverage that causes the real big swings in both directions. And while we may know, for example, that average real estate prices will eventually still go higher than their last current peaks, that doesn't mean that prices won't first fall back just far enough to take out all the nouveau riche, heavily leveraged real estate entrepreneurs and new tycoons that have come into the game to stake out quick fortunes. It's great going up, but try dumping an illiquid investment on the way down. Just look what happened to gold earlier this year, and that's a liquid investment.
Ouch.
When the bank comes a-knocking, someone's going to have to pay the piper, and that'll be when the real money will be made by the truly wealthy, probably paid for with their hordes of stored cash, ready to wait out the next big real estate frenzy that inevitably cycles through. Going back to the original topic of M3, the projected figures indicate that M3 has been growing at approximately an 11% year-over-year annual rate of change. If you go by the pre-Clinton era CPI figures, we're still showing inflation running at 5% annual rate. And if you use an alternate measure available from the shadowstats.com links in the transcript section of this vlog episode, you'll notice that the true rate of inflation could be in fact as high as 9% with all factors considered. Whichever figures you choose to believe, it makes for some seriously interesting thought. Well, we'll be needing something to pump us out of the coming recession. So how about just pumping out even more money to get things going again? Gotta be there and ready to catch the next even bigger upwave in asset prices once all the weak hands are forced out and left for broke.